what I want you all to think through is, would you rather I give you $1,000 today or $1,000 a year from now? $1,000 today, you can go invest. You can buy something with it that can give you a return. So that's great. And it's worth more because of risk due to inflation, risk, and opportunity cost. So you addressed all of these naturally, but there's actually technical terms for them, right? We have inflation, the cost of things goes up over time generally. There are deflationary environments. We're not going to talk about them. But deflation is another type of risk. But generally, costs increase over time. There's risk associated with assets, like default risk, or the risk that an asset will go down, or volatility. And there's opportunity costs. With that $1,000, you can do a lot of things, right? You can invest it for a bigger return. You could also improve your life with it somehow, right? So you can go get educated. All of these are reflected in market interest rates. We have to value the bonds with all these considerations taken in place, as well as any long-term liability. So anything greater than a year that's a liability has to be valued using the net present value. Methodology. And so this methodology, what we're doing is we're going to be taking all future cash flows, benchmarking them against a rate, what we'd call like a rate of return, and determine what all those future cash flows would be worth today. Now, why is this a valuable concept? This is the most transferable concept you're going to learn in my class. And you'll learn more about it in managerial accounting. You'll learn about it in every finance and accounting course throughout your education. And it'll get more and more complex. But you can use this to determine, companies use this to determine if they're going to buy a $10 billion business. They use the net present value model. People use it, financial planners use this to determine if their clients can retire and how much money they'll need to retire. Project managers use this to determine if a project's going to be valuable to the business or not. There's infinite uses for this. Personal finance to business to mergers and acquisitions. And bankers and investors use this to see if they should loan money to a company, or if they should buy a stock, if a stock is overvalued or undervalued. This is the gold standard of valuation. And you're starting to learn in this class. It's complex, and you'll learn more about it throughout the rest of your education. I'm still learning and being tested on it in my MBA 8 years later, 8 years since I took Accounting 101, or I think it's been 10 years now almost. So what is the net present value? Every investment has different cash flows associated with it. But there are two cash flows that are valued for bonds. We get a return on principal, and we get interest payments. Those are cash inflows. There's also an outflow on day one, right? We'll pay a certain amount of money today, and we expect interest payments and then principal at the end of the life of the bond. There are three ways to calculate the value of these cash flows. There's algebraically, which you should learn in your business calculus class. Financial calculator, I'm going to use Excel, or present value tables, also known as annuity tables. I don't like these because they're kind of antiquated, but some of your teachers are going to make you use them anyways. So the teachers that aren't comfortable with using calculators and they want you to understand the math behind it, they're either going to make you do it algebraically or present value. In real world, we use Excel or Google Sheets. So I'm going to teach you the real world.